Before we get started, I want to explain to you a short overview of what Master Trader Strategies is about and the way we educate here at Master Trader. First thing we do is define individual concepts of technical analysis. What's an individual concept? I'll explain that in a second. And we're going to define what's not to be used and why. We're going to define and understand each individual concept. So each lesson that we go over here at Master Trader will be about individual concepts, understanding how to use it, and then we're going to tell you how to interpret each individual concept. And once you become a student, our education is followed up with monthly coaching on an ongoing basis for life. Now, you have to practice what you learn, trading small, even on a paper account, and then developing consistency in following the approach. Part of our education is to teach you about changing market environments and how to adapt to them. So through experience and repetition of education, that is what leads to the mastery. Individual concepts. At Master Trader, we say price is king. Everything else is secondary. We don't use indicators. It's all about price analysis. We will do lessons on moving averages, which we use, but we do not use indicators. We look at prices in a candlestick format. Why? It's just easier to see the pictures. We are picture traders. That's the essence of what we do. We look at pictures. We look at those pictures within trends. Are they going up, down, and sideways? We look at them in multiple time frames, support and resistance. In some lessons we'll talk about volume, which is secondary. You will be part of the volume. In the moment of the trade, price will tell you when to act. We'll be talking about broader markets and their trend to give us a bias as to what's happening. Why? Because most stocks are going to be influenced on what's happening in the broader markets. Market internals and intermarket analysis combined with technical analysis is what we call a three-legged stool, or technical fundamentals. And position and money management. Without that, none of this matters, because if you don't have position and money management, you're not managing your business of trading. And just like any business, the trading business, maybe more than others, requires money management, because if you can't last in this game, you won't make it. Let's go. Hello traders, this is Greg Capper from Master Trader. Let's talk about support and resistance. Our goal here is to remove the mystery from technical analysis. That's what we do here at Master Trader. And we do that by removing everything we could look at except for the prices. Without the prices, we can't trade. So, support and resistance, what is it? How do we find it? Well, it's pretty simple. Well, let's define what it is first. They're reference points that we look at, and they come in a base, right? Some sideways consolidation, or what we call pivotal points, and they form highs and lows. Well, what's a pivotal point? Well, we define it as a bar with three higher lows to the left and right, or a high pivot as three bars to the left and right of a high bar. Pretty simple. Why three? It works. We choose three. We could have chosen two. We've looked at 4, 6, 10. 3 is a really good intermediary point to following the trend. Now, another part of our thought process is that prices move between areas of support and resistance. Where are you going to sell? That's going to be in an area of resistance, and you're going to look to buy in an area of support. And that's what traders do. They buy, or they bid at support, trying to buy cheap, and they sell or offer at resistance where reversals may form. The next part of the process is looking for areas of congestion above and below current prices. Now, we say that's going to increase the odds of chop. Why is that? Well, if traders are going to be bidding in one spot and offering at another spot, and those areas are close together, prices have a tendency to bounce back and forth until they can violate one of those areas, either to the upside or to the downside. So this sideways price action, that's another concept. Sideways price action after a move up to resistance. In this case, let's say, for example, this area here, there was some resistance over to the left, and it's going sideways. That means it's not pulling back yet. Forget what happened here. It's not pulling back yet. It's going sideways at that area of resistance rather than pulling back. So we see that as being bullish and the probability of prices advancing. And the opposite of that, well, sideways price action after a move down and prices don't bounce off of the low, where traders are bidding and buying, and then they don't eventually be able to move prices higher, that's bearish. Pretty much common sense. Now, gaps or momentum moves create a void. What's a void? Well, there is no support or resistance to the left. What we see, these eyes that are looking to the left, there's nothing there. Or is there something there? Is there something there to stop prices from going up or going down, or is there a void of support? Now, to find support and resistance, you don't need trend lines, you don't need fib lines, you don't need VWAPs, clouds, or other what we call fine tools to find what support and resistance. You simply look to the left for what's there. Eliminate all the subjective tools on the chart, look to the left. It's not proprietary, it's easy to see. When prices get there, see what the reaction is to it. Let's look at some examples. Let's look at an example of what we looked at on those slides. So we're looking at the home construction ETF. We could apply this to anything. Everything we talk about, every concept that we talk about at Master Trader is applicable to any tradable instrument in any time frame. We have to choose which instruments we're going to trade and the time frame that we're going to trade them in. We have to do that to avoid confusion. There's no right or wrong to it. If you're a day trader, you could be trading from 5-minute charts, 15-minute charts, hourly charts, or something else, and that's just fine. As a swing trader, we will typically be using daily charts and also weekly charts for a bias. So I'm using a weekly chart here, as I said, of the home construction ETF. And we're going to start on the left side, and we're going to work over to the right side. So initially, prices moved off of the low quite rapidly here. And then they eventually formed a pivot high. And we talked about pivots. What's a pivot high? It's a bar with 3 lower high bars to the left and to the right. When does it become a pivot high? Well, as soon as we have 3 bars to the right, we've already have 3 to the left. Once 3 bars are to the right, and that's been completed, we have a pivot high. Now, almost any software package will do this. It may do it with dots, triangles, it doesn't matter. In the settings, you just tell whatever it is in that package, whether they call it a pivot or a swing, you just put the setting to 3 and it'll mark the bars. So here we have a pivot low after we have 3 bars to the right. That has now created a support area, and we're going to assume prices are going to continue to go up because of this momentum move. And then we're just going to follow along. Now you see a whole bunch of bars here where there's no pivots. What does that mean? It means that demand is strong because it won't pull back. That's a good thing. Once it forms a pivot high, 3 lower high bars to the right, it has then created an area of resistance. That doesn't mean it won't continue to go up. It just means that resistance has been created within an uptrend. Now, once it's formed a pivot low, and as you know now, it's got to form 3 bars to the right, and now it's a pivot low. That now has created new support within that uptrend. We're going to mark it off with simply just drawing a line, or we can just use our eyes. And as prices pull back to that area, we're going to make an assumption. Because traders bid at pivot lows, we're going to assume that they're going to do that again. And then we're going to see actually what happens. Now, as we can see, we can apply a concept that we'll talk about in the future called bar-by-bar analysis. It then forms a pivot low here and 3 higher low bars there. Now I've got 2 pivot lows. That's created even stronger support within this uptrend. And we've got a pivot high here, and we've got this consolidation. This now creates a thought. Remember, this is a thought process we're building here using price action. Once it starts to move up, we're going to assume that this shouldn't break back down. If it does, there's been a change, and we have to begin to change our bias from up to down. That breaks down. Common sense. Now, what actually happened was it came down here into this area. It doesn't have to come down all the way down to that pivot low, buyers can step up before that, which tells us that institutions are more aggressive because it didn't get all the way down there like it was here. Here they were a bit more apprehensive and they waited for it to get all the way down here. Now, one of the concepts that we talked about was sideways price action at an area of resistance, which was what was going on here, but it didn't break down. It eventually worked out to the upside. Now, once it makes a new pivot high, we mark off this area, and now we're following the trend, and we continue to do that. As prices continue to move up, we have a new pivot high, prices begin to accelerate, we mark off this area. Now, we've got this void concept. Prices are far from the pivot low, which means prices could pull back a considerable amount without violating the trend. What we want to see now is a new higher pivot low form that it's going to require 3 higher low bars to the left and 3 higher low bars to the right. And we're going to follow. We assume once it starts moving up, there'll be buyers here again. It's an area. Sometimes they poke below a little bit and then they come back up again. Now, this is a relatively big move up, which says they thought that prices were really cheap here, and they came in aggressively and they bought. Well, now a pivot high forms before it reaches this high. Things are getting a little bit weaker. I don't know if it'll go down, but we've got a pivot low here as our reference point where buyers should show up again. We're waiting. And now as it comes down there, 3 higher low bars to the left, 3 higher low bars to the right. It's formed a new pivot low where there's been another pivot low, a more significant area of price support, and buyers are here bidding and prices went up. Do I know it's going to go up that far? No. But if this is part of my trading strategy that I'm going to buy here, I'm now in my trading plan. Now as prices move up, we continue to repeat what we call factory work. Prices went up, they began to pull back, they formed a pivot high. There's a relatively large area to that pivot low. As I said, eventually we're going to talk about candlesticks and bar by bar analysis, but I will point out to you that's a pretty big red bar, and that's power. Now as prices came down to that pivot low, we want to see the reaction. Will buyers step up again? Well, they do, but sellers drive it back down, and they step up again, and sellers drive it back down. And a third time, sellers drive it back down. This is bearish price action at an area of support. Remember the concept. What do prices do when they get there? If they can't advance, that's bearish. And then they eventually broke down. Look to the left, to the other pivot low, and they sprung back up again. But they couldn't continue to go up, and now they've broken down. This has been used as a reference point. Odds are it's coming down to these next reference points here and possibly lower. We'll have to see what happens when they get here, but I think by now you're getting the idea how to use pivots and look to the left in your own trading. I hope this helps. If you have any questions, email myself or Dan, Greg at Master Trader, or Dan at Master Trader. Bye-bye.